Do you worry about making investing mistakes? Have you made investing mistakes and you're afraid to invest? In this video, I'm going to share with you 5 more investing mistakes. This is a series that I'm doing. I realize the importance of investing mistakes after personally investing for almost 40 years and creating multiple income streams from diversified investments over the past 15 years. The very first mistake I want to share with you in this video, there will be 5, is ignoring inflation. I know it sounds really boring because it's like economic stuff, but inflation, here's how it works. It eats away the value of your money, of your purchasing power. And so remember how when you used to go to the movie and it costs a fraction of what it costs now? Well, that's inflation. So every year, on average, it's about 3%. And so inflation, it just eats away the value of your money. Certain investments, the good news is, certain investments actually keep up with inflation. An example is rental properties, I should say. So we have rental properties, as I've mentioned here before, and as inflation happens, we can just increase that rent every year in alignment with inflation because overall the prices are going up and comparable properties are also going to go up to stay even with inflation or keep up with inflation. So that's how you can overcome the mistake, is looking at certain investments that protect you during times of inflation, and considering inflation in your retirement planning and figuring out how much money you need to retire. Remember that certain investments are not going to keep up with inflation, and you'll have to spend more to maintain that same lifestyle that you're already having. Okay, mistake number 2 in this video is simply overpaying for wealth management. So this happens a lot with investments that are could be stock investments that could be in a stock index that is very low cost and very easy to purchase. And it can be a fund, or it can be an investment service, or it can be paying a wealth manager to invest a lot of different stocks for you. There are a lot of different ways people can overpay for investing and can end up incurring, 1.5 to 3%, believe it or not, investment cost, when something very similar that would have a very similar return would get the same results at a much lower cost. And the way to avoid this investing mistake is simply to have an awareness of and just do just a little bit of research to compare whatever investment you're considering to the closest index that you could purchase on your own, and seeing how you might be able to do this. Now, and also, if you're working with a financial advisor, compare the price of various financial advisors. What do they charge? What funds will they put you in? And how much do those funds cost? So this isn't necessarily about investing your money yourself if you don't want to. It's about always looking at whatever it is you're choosing to do and asking yourself and doing a little research to make sure that you're doing it in the most cost-effective way. We do that with all of our spending, yet for some reason people are reluctant to do that with their wealth management. Yet it makes a lot of sense, because over time the amount that you spend on wealth management can really affect the amount of wealth that you accumulate over a number of years. The third or next investing mistake I want to share with you in this video is simply investing only in stocks and bonds. You probably know this is sort of one of the core principles of retirecertain.com, my blog, and I've got a great free ebook over there that addresses this really specifically, and it's 9 of our favorite alternative investments. But so many people are caught up, and it's not caught up, they just assume or think of their investments as stocks and bonds only. I found that in working with financial coaching clients and in my own life, back 20, 30 years ago, I thought of investing mostly as just really being in stocks and bonds. And when you think of only stocks and bonds for your investments, you really limit yourself to what else is possible. And for example, the investing mistake number one that I gave about the rental real estate, as an inflation hedge, that would be out of the picture if you were only looking at stocks and bonds for your investment. So the way to overcome this investing mistake is simply to think broader, think outside of the box, and look for investing possibilities or investing options that are outside of investing in traditional stocks and bonds. The very next mistake I want to share with you is simply not tracking your investments. I heard one time, and it's been years, I can't remember where I heard it, but the speaker was saying that the biggest thing that people feared was updating their net worth or knowing or calculating their net worth. That's crazy, because you have to know where you are. You have to know the value of your investments and track how those investments change, how your net worth changes every year in order to make good decisions around that, in order to plan for your future and make sure you don't run out of money, right? And so not tracking your investments is a huge investing mistake. And the way to overcome it is really easy. You simply track your investments. I found that having some structure around that, like once a year, once a quarter, if you just put it on your calendar by the 10th day of the quarter, you've updated your net worth from the previous quarter. Something like that works really, really well for me. I think it's also smart to update your net worth or track your investments if you've had a big change in your situation. Maybe we've had a bear market, or maybe you've inherited some money and your overall picture has changed significantly. And the next mistake I want to share with you is confusing realized gains or losses with unrealized gains or losses. So a realized gain or loss happens when you buy a security and you sell it and you incur a loss or a gain. An unrealized loss or gain happens when you buy something but you don't sell it. You just experience that increase or decrease in the value of your investments. Now, an example of that might be you put money into stocks and stocks go up by, say, 40% over the few years after you invest, 3 or 4 years. And then let's say in that situation you have an unrealized gain. You haven't made that money. Your net worth has increased though by the amount of that. And that's what's so important to understand, and that's why it hits us in the gut when the value of our stocks drop and we hear, well, don't worry, I'm a long-term investor or whatever. But it's the value of your net worth goes down and your ability to, get a mortgage or your whole deal around, your assets have declined in value. That is with an unrealized gain or loss. So you haven't sold it. Now, on the other hand, let's say that you have a security or you put some money into stocks and they go up in value that same amount. I think I said 40% over a few years. And you sell those securities, okay? Because you see the market's gotten pretty, top heavy. You feel like you've reached full valuation of those stocks. And so you decide to sell them. Then you have a realized gain. That's a real gain. You've got it. You got to pay taxes on it maybe. You can take that to the bank, right? And then you can invest that money somewhere else. That's a realized gain. So a lot of people get confused about that, the realized gain or loss versus the unrealized gain or loss. And there's a lot around taxes with that. I won't go into that because I am not a CPA, but be aware of it and know the difference between a realized gain and an unrealized gain and the impact that has on your net worth, of course on your taxes, and also on your ability to accumulate wealth. So that was mistake number 4. Mistake number 5 in this video is to avoid paying high fees on index fund performance. Now, this is really highly related to an earlier investing mistake that I mentioned, and that's overpaying for wealth management fees or overpaying for investing fees. And with this one, it's really simple. But the thing is, with this particular mistake, you can invest in the S&P 500 index, which most of us are all familiar. If you're watching me, you probably are familiar with that, or you've seen my other video on that. You understand the importance of the index concept. So let's say that you want to invest in the S&P 500 index, and you can do that for very, very low, less than, and the way I say this is 0.1%, okay? I don't go into, some people call it basis points and all that. Let's just say that it's 0.1%, so very, very cheap, under 0.1%, right? That's super, super cheap. You can also invest in the S&P 500 index fund paying 1%, believe it or not, or more. And so if you decide to invest in index funds, it's super important to make sure the way you're investing in that index fund is through the lowest cost way. And I'll even say, there are different types of funds. So you can get the same assets, the same investments at a lower cost. That might be comparing mutual funds to ETFs, for example. That's what I wanted to share in this video. If you found this information helpful, I'd love it if you would click the thumbs up below the video. Let me know. Come see me at retirecertain.com. Remember, I've got a fantastic ebook on all of this and more. And subscribe to my channel so you don't miss any of my videos. Thank you for watching.